Hello, everyone. I'm Henry Durkis, newest member of the Rebellionaire team. I'm best known as Henry Invests on X, where I spent a lot of time covering a fintech company called Upstart. You may have seen me in Rebellionaire's earnings preview video, and today I want to touch on a lot of the points I made going into the report, as well as what Upstart's earnings actually looked like and why their results were pretty differentiated relative to other fintech peers. At Rebellionaire, we use a couple of different tools to really help us get a better understanding of what the quarter is going to look like for Upstart. One of those tools is called UpstartIQ. And what this essentially does is it takes Trustpilot review counts for Upstart, which are consumer reviews left on Trustpilot, and it extrapolates that using a few other variables to arrive at a revenue estimate for the quarter. Upstart guided for $280 million in revenue this quarter. We predicted that they were going to do $275, a hair light of what they had originally guided for, and they ended up doing $277. So that estimate was rather concise. Now, looking at the Upstart Trustpilot Index, which is a 28-day moving average of these Trustpilot reviews, you can see that really in early August and September, there was a sharp deceleration in review activity. Well, it turns out that we actually caught Upstart's model tightening through the Upstart Trustpilot Index, and we'll get into a little bit more about that later. But really what happened for Upstart in Q3, according to management, is that they didn't originate as many loans as they thought, even though application volume surged 30% quarter on quarter to a new all-time high, simply because their models started to predict more macro risk that caused them to tighten the credit box very quickly, which resulted in them missing their internal fee revenue estimates. The reason Upstart's models tightened is because of a roughly 20-point move in the Upstart Macro Index. So for those unfamiliar with what this is, it's abbreviated as UMI, and essentially, it's a measure of the macroeconomy's default, like the macroeconomy's effect on defaults for Upstart-powered loans. So you can think of 1.0 as normal. Anything above would suggest the macro is being an impediment to growth, as UMI is a pricing input for Upstart. And anything below 1.0 would signal that the macro is actually being a tailwind in terms of originations. So if you want to look at that over time, you can see when the Federal Reserve had interest rates near zero, UMI was doing really well. And now, as the economies emerge from that zero interest rate environment to higher interest rates, UMI has ticked up. In particular, Upstart is highlighting this move from roughly 1.40 to as high as 1.59, which was actually revised down. It got as high as 1.62, as something that caused their models to really tighten very quickly. Now, if you think about what Upstart is doing, if we're believing that they are this truly unique technology company that is building a foundation model for credit, and they're trying to react as quickly to moves in the macro as possible, I think the fact that Upstart tempered back originations this quarter while other fintechs actually grew suggests that even if maybe their underwriting is not good, if you're of that opinion, it's at least very differentiated. So as you can see, when the macro risk goes up for Upstart, it actually causes them to price their loans more tightly. Now, really what happened this quarter was a sample/population error. Paul Gu, the CTO and co-founder of Upstart, on the call explained that there was a sample error, meaning that the Upstart model identified a few pockets potentially of rising risk and then extrapolated that and applied it to repricing loans across the entire marketplace at a higher clip, which was probably what CEO Dave Gerard calls an overreaction. But Upstart engineers went back in, cut the macro noise volatility by as much as 50%, and they think that they're in better shape moving forward. If you are a Tesla investor, you can think of this potentially as Tesla FSD running over a few curbs, right? Then the engineering teams have to go back in and recalibrate it. I think most importantly, the key point from the macro tightening here is that Upstart is not willing to sacrifice transaction volume or credit performance, for transaction volume, and that their model is truly underwriting very differently than anybody else. Whether that's good or bad remains to be seen. At a high level, this was still a very good quarter for Upstart. Originations grew 80% year over year, revenue grew 71% year over year, and they were vastly profitable with an 11% margin. If you look at their transaction volume here for dollars, you can see that they were up 80% year over year, but just nominally higher quarter on quarter. And this is also reflected in the Trustpilot review trends that we shared with you all prior to earnings, where Trustpilot reviews actually only increased about 7% quarter over quarter, deceleration from previous growth rates, which is reflected here in the transaction volume. Now, another thing to remember about Upstart is that the entire premise of Upstart is that they're able to use AI to better separate risk, meaning that they're able to underwrite, approve more borrowers that potentially legacy credit systems would not. And so you can think about that in terms of conversion rate to a degree. So If Upstart is converting more borrowers, their models are getting more accurate, so they're able to successfully approve more borrowers at lower APRs. So the conversion rate this quarter was 20.6%, vastly higher than where it's been in quarters previous, except for last quarter, where the conversion rate was a remarkable 23.9%. And the reason that conversion rate stepped down ties back in to what we saw with the model's increased macro pricing. So Upstart offered fewer high-dollar loan amounts this quarter. Interest rates across the platform were broadly a little bit higher. That resulted in less conversion, meaning less borrowers accepted the loans, even though aggregate lending demand reached its highest point ever. Interesting dynamics there. Some other slides here from the slide deck. What I really want to highlight is the balance sheet. So if we go back down here to the balance sheet, we can see that Upstart's balance sheet, the loans on the balance sheet, went up roughly $200 million quarter on quarter, about a 20% increase or step up. Now, primarily, the credit book is composed mostly of R&D, research and development loans. You can think of that as their new products, auto, small dollar loans, SDL, and what they call home, which today is only HELOC, although they did announce plans to expand into purchase mortgage at their investor day in May. So a large part of the credit book is comprised of these R&D loans, about 70%, which was up from 66% in the quarter prior. So if we take a look at that and how that translates in terms of a funding mix, if we go to Upstart's 10Q and we look at their management discussion and analysis portion, we get a breakdown of what that balance sheet usage really looks like, because primarily one of the concerns that are sending Upstart shares lower following their results is that balance sheet usage. What's come to be is a narrative of increased reliance on the balance sheet, questionable credit performance for these new products, broad macro uncertainty, and really just a fear that Upstart does not have the ability to offload a lot of these balance sheet loans. And if that is the case, which it is today at that point in time on the balance sheet, then it should be valued a lot less like a technology company and more like a traditional lender, considering they carry substantial credit risks. We're going to talk about a few key points here. The first is that I want to talk about the actual distribution of loans that are originated on Upstart's marketplace. So if we look year to date, so through 2025, the Q3 results, Upstart has originated roughly $7.8 billion in loans. 62% of that was originated by institutional partners. You can think of that as your private credit, your Castle Lakes. 25% has been originated by lending partners. You can think depository institutions, banks and credit unions. And 13% of that has been originated directly by Upstart's balance sheet. You can see on a year-to-date basis, Q2, 21% of all loans originated on Upstart's marketplace for the year were on Upstart's balance sheet. That actually shifted down to 13% in Q3. So if we break that down using some reverse engineering, what we end up getting is that Upstart actually did not originate any loans directly on their balance sheet this quarter. Almost all of the funding came from private credit and lending partnerships. On that front, they also announced that they had 100% private credit retention to date, and they were in a lot of agreements to sell some of these loans off the balance sheet. But why is this important? If Upstart's not originating loans directly on their balance sheet this quarter, but total loans on the balance sheet are going up, it suggests that they are purchasing R&D loans from other parties in order to have that loan go up. Maybe there are fair value marks in play, but I don't think it would explain a 20% sequential increase. And so if we think about that, I think it's very possible that Upstart is having a third party such as Pathward, who's one of their newest partners, originate these loans and then ups as a capital front, and then Upstart buys them back immediately. So there may be some accounting gimmicks there. But if we continue to look at the balance sheet usage, we really come at somewhat of a different narrative than what is going on today. So the narrative is that Upstart is originating all these loans and plugging them on the balance sheet, which is true. Total balance sheet exposure is going up, but it's a little bit more nuanced. So today, there are $1.23 billion of loans on the balance sheet. That's a $424 million incremental increase relative to the end of Q4. However, so far, year to date, Upstart has originated about $1 billion with using its balance sheet. So that would suggest that although they've originated $1 billion, since they've only retained $424 million, they've actually moved a decent amount of those loans. If you look at the transaction volume year to date, you'll see that was about $7.8 billion. So if we take that $424 million incremental difference in loans on the balance sheet from this quarter relative to the end of last year, That would insinuate that Upstart is plugging about 5.4% of their transaction volume on their balance sheet while rapidly scaling new products, auto, HELOC, and small dollar loans. So in short, what I think that suggests is that although the total balance sheet exposure is going up, it's not necessarily a scenario where there's a huge lack of funding for these products. And in fact, on the conference call, management said probably 5 or 6 times that they had intentions to move these loans off the balance sheet by the end of the year and into 2026, as well as set up forward flow funding agreements for these new products in the future. Now, the big question is, can we take management on their word on that? While they did not promise tangible outcomes on the balance sheet in Q3, they did suggest that there would be some improvement, and there actually was not, right? Because aggregate loans on the balance sheet went up. So I think the market is starting to really discount the credibility of Upstart's management until they can provide tangible outcomes on the balance sheet. CFO Sanjay Datta said on the conference call they expect tangible outcomes in this regard about the balance sheet by the end of the year. But as we look at the balance sheet is more encompassing, if we look at the transaction volume and the flow of where these loans are going, the balance sheet usage does not initially seem to be as high as maybe many expect. The other worry about the balance sheet comes down to the credit performance. A lot of investors are concerned that the credit performance of Upstart's new products, auto, HELOC, and small dollar loans, are not really all that profound, which is going to make it difficult for them to move the loans. While that could be true, there is some broad-based macro stress in non-prime auto and other segments of the market. We actually got some really interesting insights from Sanjay Datta, the CFO, on the conference call. The first of which was that if you think about it from a borrower health perspective, in terms of UMI, non-prime borrowers, so 600 FICO score, is actually at about a 1.2 to 1.3 UMI, with their default trends aligning relatively close to where they were pre-COVID. And more primer borrowers in the mid-700s, which represent Upstart's prime originations, were actually seeing increased elevated UMI. So their default rates are actually a little bit higher than where they were pre-COVID. So if we think about that in terms of consumption, it's very possible, in my opinion, that non-prime borrowers actually were first impacted by the inflation and interest rate shock of 2021 and 2022 and had to temper back a lot of their spending and consumption habits to better align their financial profile. That could explain why they've recovered to more normal default rates today. However, prime borrowers who could likely absorb more of those macro shocks are just now starting to crack, according to Upstart, which is why their prime originations have actually decelerated a little bit in their growth rate quarter on quarter as the model reflects tighter underwriting as a result of increased risk. So I think Upstart is aware of the increased credit risk that is going on. If you think about the balance sheet, again, getting back to that, the balance sheet actually provides net interest income for Upstart. So Upstart guided for $5 million in net interest income this quarter. They ended up posting $19 million, a rather substantial beat, which would suggest that the credit performance of the underlying balance sheet is quite strong. There is also a theory or a possibility that net interest income outperformance came from incremental additional loans on the balance sheet and that Upstart did not expect to carry that large of a balance, which is also possible. But another key insight that we get on credit performance comes from Upstart's co-investments and their committed capital partnerships. So if you think about Upstart as a business model, they don't want to hold the loans that they are underwriting, right? They don't want to hold the originations. So a new part of the creative structure involves working with not only private credit, but also depository institutions to share risk on the underlying credits in exchange for funding. So a recent example would be Upstart working with Pathward Bank, who I mentioned a little bit earlier in this video, a $7 billion asset, and that's one of Upstart's largest partners in a very long time. And so what they did is Pathward is purchasing portfolios of loans from Upstart with the idea of holding them for sale for 30 days and then selling them to some other private credit investor. During that 30-day window that Pathward is originating and holding the Upstart loans, Upstart shares the credit risk with them and provides indemnifications. In that instance, the Pathward example, it is 100% credit indemnification. That is not always the case, but for the sake of example, that is for this anecdote. A lot of this credit risk reflects, on this slide right here, the value of Upstart's co-investments and committed capital partnerships. So how much exposure do they have in these risk-sharing agreements? In Q3, that ramped from $632 million to $770 million. That ramp was not unexpected and was clearly telegraphed by Sanjay in the prior quarter, and they expect that is still nearing the end of its ramping phase, but it will probably increase, I would imagine, to maybe just shy of $1 billion. What's important on this slide, however, is that little gray bar underneath the big solid green bars, because that shows you what Upstart values those agreements at today. And you can see that the $770 million of capital that they've co-invested, in their opinion, is worth $824 million today. That is the largest step up in a fair value markup that they have seen, which would suggest that the underlying credit performance is doing well. And they said on the conference call several times that their credit performance was doing exceptionally well. One last thing I'd like to add on the balance sheet comes down to the growth rate of these new products on a quarter-over-quarter basis. So small dollar loans are reported under personal loans. I'll put up a separate chart that we at Rebellionaire made here, and you can see that is actually growing really quickly. And it's part of the reason that average loan sizes for Upstart are coming down. Paul Gu also said that they were able to provide instant funding in as little as 90 seconds for these small dollar loans today, and that investors should expect more in this segment soon, potentially referring to revolving credit or some form of credit card, which might be in Upstart's near-term future. But primarily, I want to focus just quickly on auto and HELOC originations. Auto originations grew only 9% sequentially, probably in part because of the model's increased conservatism. But I also think there's another factor at play, which is Upstart is deliberately choosing probably not to ramp a lot of these originations right now until they line up more funding. And I think that's probably why the growth rate on these tempered a little bit in combination with the actual increased macro risk, if you will. But home originations as well, we can see a very similar trend of a very slow sequential growth. And so it's important, I think, to realize that this slowdown in growth may be a little bit intentional as well. And as we look into 2026, which Upstart management, Dave Gerard, CEO, now seems to be saying is like the year, these products will probably be meaningful contributors there on out. Now, as a percentage of total originations, auto, HELOC, and small dollar loans actually increased to over 11%. And kind of like what I was talking about earlier, prime originations now represent over 20% of Upstart's total originations. The credit book is a little bit more diversified, but Upstart might be laying off the gas a little bit until they have more funding sources in place. So as a result of Upstart's increased tightening in their underwriting, they really looked very different from peers this quarter, which Wall Street did not like and attributed that to maybe it's just an Upstart issue, which it certainly is. Earlier in this video, I made a point that it's very clear that Upstart has differentiated underwriting, but the more difficult question is whether or not that is a benefit or a con to Upstart today. If we look at Trustpilot reviews and where they may be headed for Q4 is a preliminary estimate. If we just quickly go back to guidance, Upstart trimmed their full year, basically their Q4 guidance to about 288 million. I think that was a trim from about 305 million. And the full year guidance went down from 1.055 billion to 1.035 billion. So a very small trim. You'd have to think if you're Upstart here, you don't want to go into a scenario where you're missing top-line expectations 2 quarters in a row. This is a team that, if you take out 2022, actually was like 2 quarters in 2022, was really consistent on delivering with revenue estimates. So that's something that they probably want to get back to. If we just take a look here at where Trustpilot reviews are coming in potentially for the quarter, we can see that a linear regression model assumes that there will be 17.5% quarter-on-quarter review growth, going from 2,600 in Q3 to a little over 3,000 reviews in Q4. Now, I think at Rebellionaire, we've proved that Trustpilot review trends do have strong correlation to Upstart's underlying fee revenue. And while Trustpilot reviews were a little bit weak to start the quarter, they are starting to ramp up pretty significantly. If we were to take that estimate and look at it in terms of an UpstartIQ scenario, once again, this is just a total prediction. It is not encompassing of all these other variables. So do not place a lot of emphasis on this. It's just a preliminary method to potentially look at where the guidance may, or the actual results may come in. If we assume 3,000 reviews, as well as a similar review rate and a revenue per loan that is still falling a little bit, 2.5% here, it models pretty well for about $310 million in revenue. And so I do think that there is a potential where it could have been slightly a kitchen sink quarter for Upstart in what they're calling a speed bump in getting back to pretty rapid growth. So as we broadly think about this quarter for Upstart, I want to highlight a few things. Number one, I think the top line revenue miss was not something that really surprised me. And in fact, I think at Rebellionaire, we shared that was our expectation. Now, the rationale behind that, we didn't really know, but now we know it was increased model tightening. I think this is important because it shows that Upstart's underwriting is truly differentiated from everybody else. And important to note, too, that during the conference call, Upstart said that they had more funding than needed for their core non-prime personal loan business. So I don't think funding has been an impediment to their growth this quarter. I'm inclined to believe that management is telling the truth, that the model actually did overreact in really what is like a first micro macro model test at current capacity. I think the biggest red flags that remain for Upstart are issues that have been rather widely known, but maybe a little bit more pronounced during this speed bump. I think if anything, Q3 has reinforced that Upstart's growth is very sensitive to model-driven macro pricing changes. That can be an impediment to growth when the macro starts to deteriorate. That could also be an accelerator. But Upstart's model is making decisions, and it appears that Upstart's management, they'll go back in and they'll recalibrate and they'll retune, but their philosophy is to listen to the model. So that's what you want from a machine learning company. You don't want executives second guessing the model. And Upstart was willing to miss their quarterly guidance this quarter because they trust their model. I think that says a lot about the vision and the team over there and the fact that they are AI native, but it does also pose a lot of risk given the fact that growth and guidance can potentially be a little bit unpredictable. The second major risk is, of course, the balance sheet. Wall Street does not like the balance sheet. We talked about that bogging down multiples. We talked about the fears about credit performance and being able to sell all of those loans. I think Upstart was very clear on the conference call that they were close to moving a lot of these loans, but the market does not trust management. And that leads me into my third major risk really that I think was pronounced at the end of the quarter, which is Upstart's management and communication style needs to improve. It appears that Dave Gerard, the CEO, is not very well liked amongst a lot of Wall Street investors and certainly now retail investors. That doesn't mean he's not doing a good job running the company. This is a company that emerged from 2022 when everybody thought that they were going to be dead. They also had a lot of non-prime personal loans on the balance sheet during that time that weren't even calibrated for macro pricing, which they ended up moving, albeit they did move it at a rather large loss or a write-down. To me, I think management has lost control of the narrative. I think they joined the conference call. They were very monotone. We have pre-recorded remarks. There's not a lot of excitement. Potentially, that's because Gerard is maybe losing a little bit of his energy, right? He's been doing Upstart for 13 years now. It just feels like it's just struggling to get over the hump. And I think Paul Gu's answer is, while very helpful in understanding the model, were a little too verbose and made it difficult for analysts to understand what was going on with the model, which created this illusion that, hey, maybe like Upstart doesn't know what's going on with the model, which machine learning is partially a black box, but I do think that Upstart could have communicated that a lot better. In my earnings review, I shared that I think that the future for Upstart might be Paul Gu. He's a Peter Thiel fellow. He's been at the company, he co-founded the company, I believe, when he was a minor, and he's still there today. So I think we're maybe entering a phase where Paul Gu is learning the ropes, he's more involved, and could potentially emerge as the next leader for Upstart. Although I do think whatever it is, the communication from Upstart has to be a little bit better so that the business is not so difficult to understand, or that their explanations maybe are taken with a little more seriousness rather than just being discounted because of some of the actions that the management team has made in the past. I think overall it was an okay quarter. There's a speed bump in originations. I'm not caught off guard by that. The Upstart Trustpilot Index caught that. I think it's broadly a good thing that Upstart would temper originations in exchange for credit performance. And I think that is probably the right move long term for the company. But I do understand and acknowledge that is a bad result for the share price short term, that Upstart looks like they're on their island right now and that everybody else is growing. Why can't Upstart grow? But I think hopefully some of the points that I made today can maybe help you understand a little bit about why we at Rebellion Air are more bullish on Upstart than others, and why we think their approach is truly unique and differentiated, and how on the other side of this, there's a lot of runway for growth. Thank you everybody for listening to this video today. I'm Henry Invest on X, newest member of the Rebellion Air team. Bye for now.